morning, ladies and gentlemen. Apologies for the delay. Welcome to the one-day seminar on auditing standards. The expectations on the profession, from the auditing professionals, has been on a constant rise. Be it the recent debatable linkages to the corporate collapses or the fallouts of the misdoings, be it the unnecessary limelight on the profession, be it the continuous resignations of auditors, be it the introduction of NAFRA, or be it the continuous changes in the regulatory framework that will impact the businesses, or be it a bunch of other reasons. All these have sort of heated up the kind of space that we occupy, the kind of audit profession that we all own today, all of which have led to the increased responsibilities on the auditors. ICAI, in order to bring the Indian standards in auditing in sync with the international standards in auditing, has been making a lot of changes. In the current year, for all balance sheets starting April 18, one such major reporting requirement is to communicate on the key audit matters. There have been a lot of other changes, primarily the reason why we are having a one-day seminar on all these changes. Today's seminar, in a nutshell, will cover about all the changes in the risk assessment space, the internal control procedures, documentation changes, what should be contained in our work papers, and what are all the changes in the new audit report format. Following the same format that we follow for the one-day seminar, we have 4 speakers for the 4 different sessions. We have CA Sundaresan, CA Shyam Ramadhyani, CA Amit Somani, and CA Ankit Daga, who will be sharing their knowledge on all these topics. We have with us the first session speaker on the days with us. Please welcome with a huge round of applause CA Sundaresan. I request CA Venu to kindly come forward and present a bouquet of flowers and welcome the speaker to the seminar. Friends, couple of important announcements before I hand over the podium to the speaker. We have a one-day seminar on the e-commerce industry, following our series of seminars on the various industries that we've been doing in the past couple of months. This is scheduled on 19th of January, that is the next Saturday. Online registrations are available for this program as well as usual. As all of you are aware, the CPE compliance requirement has been extended till 31st of January. We have an important session on US taxation, which is going to be a half-day seminar. This is scheduled on 28th of January between 5:30 and 8:30 in the evening on 28th of January. Of course, another important announcement that affects the branch is the upcoming elections to the managing committee of the branch for the term 2019 to 22. That is scheduled on January 27th. I request all the members to kindly come forward and cast your valuable votes. Let me now take this pleasurous task of introducing the first session speaker. Sundaresan is partnered with Deloitte Haskins & Sells LLP for more than 32 years. He has handled audit and assurance services of large listed companies as well as SMEs. He has extensive experience in cross-border reporting for multinational companies under IFRS. He has experience in providing services across a wide spectrum of industries like technology and telecom, FMCG, manufacturing, banking and finance. He is also involved in group audits through global shared service environment. He is a lead on various services to clients including internal audits, control assurance services, SOX compliance and due diligence. With this brief introduction, I present to you CA Sundaresan. Over to you, sir.
Good morning. The issue of taking the first session is after people turn up late. Okay. That's one of the reasons for delaying it. I was here at 9:30. Okay. Today we are talking about auditing standards. If you look at the profession, a lot of us do audits. For instance, I do daily, day in, day out only audits. Okay. Any professional who is practicing must be doing audits as a part of his practice. But unfortunately, we do not concentrate so much of our auditing standards. The problem which is facing the profession is not to do with anything with taxation or accounting, the problems which are facing the profession and the publicities which we get is entirely due to auditing. Okay, the companies goes bad, and and one of the things is what is the auditor doing? Okay, so I'm not going to enter into that conversation, but I wanted to tell, as far as the profession is concerned, the risk in the profession is actually mainly in auditing. If you look at, if you give a wrong advice, at the most you will not be called for advice second time. If you are in a tax thing, at the most you will say you will change over to another consultant. But when you are doing an audit, if you do a wrong audit, it reflects on you, okay, and it reflects on the profession also. So audit is an area of risk, okay, and we have the standards, and whether we have done the audit as per the standards or not is what we should be judged upon. But we are never judged upon, no one who is commenting on us knows about auditing standards. They say something has gone wrong, what was the auditor doing? So it has now become a perception what he was doing. If something has not gone wrong, the auditor has not done his work. That's it. Okay? That is, the business failures are being treated as of audit failures. Okay? So this is a perception which is happening in the industry. So because we are being treated based on perceptions, I think we need to be more careful when we are doing the audits. And whenever we are being judged, whenever we go to disciplinary proceedings or anything, we are being judged with our own auditing standards. Okay? If you look at a SEBI order in respect of the firm which has happened, they just taken the auditing standards and then word by word they say this standard says this. The auditor has not done this. This standard says this. The auditor has not done this. So the whole, and the person who is judging is not a chartered accountant. And in NFRA's count. And the persons who are going to judge us whether we have done a proper audit are not going to be chartered accountants. We are only a part of the thing. 3 out of 12 team is going to be the CAs who will be sitting there. All others will be non-CAs. Okay? So it's unfortunate. If you have done, no other profession has got that kind of a thing. For instance, if a medical profession, the person who is judging the medical negligence is all doctors. Okay? So if you go to the bar council, who are judging them is all lawyers. Unfortunately for us, because of the regulators, it's true throughout the world, but internationally the persons who will be judging were accountants, PCOB or anything, those who are manning them predominantly are the accountants or auditors who have done their audits. Whereas here, this is going to be dominated by various others, the professionals or bureaucrats, legal people. So everyone is going to judge us. At the end of the day, it's going to be through the auditing standards. And if you look at it, the programs which he conducts is an example. You can take the list of the programs which you are conducting. Auditing standards must be the least in numbers and percentage. I can bet, I can vouch. Okay? It has been forced upon the institute, you must have a section on auditing standard. Possibly this will be third or fourth section in the whole year. Okay? So that is where I think we are lacking. It is true for us professionals who are doing audit, we concentrate a lot on accounting. Whether the accounting has been done as per the accounting standard, so much discussion takes place, so much of the things. So what we are doing is actually we are protecting the client to ensure that the accounting is done properly. We are not protecting ourselves because we are in charge of auditing them and reporting on them. Okay? So I think it's needed, whoever is doing the audit, please go through the auditing standards. Okay? I will have, for instance, SMEs. We do not have a publication which is focused on SMEs. I am just going through it. There is a IFAC, 2 volumes there. IFAC standards, our standards are more or less the same except for the standards on consolidation. So they have 2 volumes of publication which is available in IFAC website. Okay? Don't think that it is meant for somebody, US, UK and all, we are in India, it is not meant for them. No. I was surprised. I was going through my session on risk assessment and there is a guide, the volume 2 is on practical application. And the example given was some B. Kumar and Co. Okay, so it's obviously somebody from our Indian team has contributed to that. Okay, it's a very nice 2 volumes. I cannot give it to you because of copyright. You can easily download it. You go to IFAC site and then you download it. I will just show it to you towards sometime during the things. It's a very nicely written volumes. It actually makes the standards easier to apply. Okay, and there are 2. Second volume is on practical case studies and how you can do that. Okay, so if time permits, I will just go through briefly on that. Okay, the topic which we are starting, risk assessment and internal control procedures in audit. Risk assessment is a core of the audit. If you ask what the audit, as per the auditing standard, is basically identify, you have a risk assessment, identify the risk of material misstatements and ensure that the risks are mitigated as far as audit is concerned. Okay, how do you address the risks which are there in the risk in an audit? Now, what is a risk? What's a risk? I don't want to just do a lecture, I just want to be interactive. In fact, last time I did something was completely interactive. It was. I can't do that. What according to you risk?
Misstatement.
Just take an example. The morning you wake up and you woke up and came here. What are the risks that you think? Risk of delay in attending this. What are the risks you face according to you?
Traffic.
One is traffic.
Waking up late.
Waking up late. What else?
Accident.
Accident. Accidents. Your car not working. What else? Well, I would say the fundamental risk of my life to come here or not. We call it in business terminologies going concern. Okay, I like to come here. What is the one important thing which is running across all the things you told?
Going concern.
No, important things. Somebody said waking up late,
Non-achievement of
waking up.
Yeah.
Non-achievement of
What?
Non-achievement of
Non-achievement. Okay, put it differently, something can go wrong. When we are looking at risk, we are actually, our thing is to see if what can go wrong. That's all. This is same thing here also. A risk means what is the risk? What can go wrong in preparation of the financial statements? Okay, we extend that risk of, we are not interested in minor items. Okay, if you say 5 minutes delay it is going to take place, it's a risk, but you are not bothered. 5 minutes he is not going to, he will get whatever his attendance he will get. Okay, but if you are worried if it is 2 hours delay, okay, it's a material delay. Okay, you will miss out 2 hours, you may not get credit or anything. So what is important in an audit, in a financial statement, is not just the risk of misstatement, it's a risk of material misstatement. Okay, misstatement you can say something can go wrong. For the time being, we have some example of what is a misstatement, there are definitions. Okay, it's all common sense. So risk of material misstatement is what we are looking at. Okay, the whole audit is identifying the risks of material misstatement and addressing those risks as an auditor, whether the risks are mitigated. That's a whole audit, that is the core of the audit, I would say. Okay, all the standards are all veering towards this. Okay, your internal control, your substantive audit procedure, documentation, all of them. Okay, the focus is on this. It's very important to have the risk assessment. I'll tell you, my colleague is here. It's a very difficult topic for us, even in a firm like us, to implement practically. It involves a lot of judgment. Okay, people take a balance sheet and start doing an audit. Okay, I will check fixed asset, I will check sales, I will check. Okay, that is not the correct way to do the audit. the audit envisaged in the auditing standard is a risk-based approach. Now, why a risk-based approach for audit? Your auditing company is auditing, there is a finite time in which you have to do the audit. That's number one. So you have to ensure that your time on audit is effectively and efficiently done. Number two, the audit has to focus on areas where things could go wrong. An intelligent auditor will not focus on things which cannot go wrong. Okay? So we need to identify the things where the things will go wrong and then focus on it. So that's where the risk assessment, risk-based audit approach is important. That's how the auditing standards of envisage the risk-based approach. The second, risk-based approach and all is fine for big companies. No, it is not. Actually, what this risk-based approach can work very well in two things. In respect of bigger companies, it will identify the areas in which you need to focus and do the work and possibly increase the work where the risks are higher. Okay? In the smaller companies and medium companies, it could actually reduce the work also. Because we will, for instance, we have something called cost plus companies in Bangalore. There are in-house centers of multinational companies who are here. They do billing based on their cost, let's say 15%, 20% or whatever it is. The risks there mainly is only on the transfer pricing. All other things, because they are all subsidiaries, there is nothing much to do. They don't misstate the results and all. It's only a question of cost plus. So the risk involved is reduced substantially if you follow a risk-based approach. Okay? That is also an important criteria to follow the risk assessment. Now, how do I go about it? These are the things. This major thing is on assessment of risks. Okay? The standard says through understanding the entity and its environment. Then the second part is responding to the assessed risks. That is where the audit process takes place. You identify the risks and identify what you will do to address those risks. What are the tests you will do? Okay? What are the tests of controls? What are the other tests you will do? That is what their response to assess risks. Then there are some other topics like evaluation of identified misstatement, communication of deviation to those charged with the governance, use of service. We will briefly touch upon those standards. They are all important because we totally miss out. Okay? I will just but the major thing is on the first two topics. Okay? Okay. Now, audit risk. We are looking at here the risk from the audit perspective. Now, what is the risk from the audit perspective is the risk of material misstatement in financial statement are not found out during our audit. The risk of material misstatement not being found in our audit procedure, being missed out in our audit procedures. Okay, that is the audit risk which we are running. We are not interested in the business failure and other things. The business have got various other risks also. So that is the major reason we are doing this risk assessment. Okay. Now, for doing that, we need to identify what can go wrong in the financial statement. Now, what can go wrong in the financial statements? It can be done in two ways. There could be unintentional errors. There can be intentional errors. Unintentional, we call it errors. Intentional, we call it fraud. Okay? Fraud can be of two nature. That would be fraud happening in the company because of that whatever is you are disclosing in the financial statement could be wrong. The second kind of fraud which we are more concerned these days is fraud on misstatement in the financial statement intentionally by the management. Okay? So this is a financial statement fraud. Okay? So that is what, for instance, the banks, they say they are not providing for it, the provisions are not made. So that is all they are looking at errors or fraud, whatever it is. It will fit into one of them. Errors in interpreting the regulations, okay, or purposely, intentionally not doing certain things, okay, or intentionally inflating the sales or reducing the sales. That also could happen. Okay, so these are the two ways in which the misstatements could happen. Now, what is a material misstatement? That's very important. So, I'm not covering what is materiality. Material misstatement is basically a misstatement which could affect the reader of the financial statement, who is reading the financial statement. Suppose if the profit, say it's 1,000 rupees, 1,001 rupees, 1 rupee there is a difference. Is it material? It's not material. In 1,000 rupees of profit, let's say 500 rupees changes, 50% of the profits. Okay? So that would be a material misstatement. Now what is material depends on, there is a separate standard on materiality. It depends on how the reader of the financial statements looks at it. What are the key figures they are looking at it? Okay? It's not necessarily profit all the time. Because we are in Bangalore, a lot of startups and they never make profits. Okay? It doesn't mean they are not valuable. Companies which are sold at billions of dollars, okay, they will never make profits. Okay? Don't ask about valuation, but that's a different story. So in those cases where the profits are not there, you cannot adopt the profits or loss as a materiality. You need to identify, say, part of the sale, percentage of sale, or some other criteria. This is a separate standard. So if you identify the materiality, a material misstatement is a misstatement which is about your materiality individually or collectively. Okay? So that is the way we are looking at the material misstatements. Now when you are looking at a risk of material misstatement, we are looking at what are the things which could be misstated in the financial statement as a whole or individual components of a financial statements. For instance, whether the sales can be misstated, okay, purchases could be misstated, okay, your taxes could be misstated, okay. So like that, what are the items which could be materially misstated that we are looking at? Now, each entity, it could be different. It is a matter of the judgment. Now, what are the things which we are supposed to look at, how we have to look at it, what is the process which we need to follow, that is what is being dealt by the standards. Okay? Now, what can go wrong? The simple process to be adopted practically, this is what we do. You just do that, what can go wrong? Now what can go wrong can start not just with the financial statement. Okay, if you read the standard, it's understanding the entity and the environment in which it operates. That is very, very important. So the audit doesn't start with financial statements. Audit starts much earlier, much broader. The audit starts in understanding the client, the business in which they operate, the economic environment in which it operates. Okay, that is all needed to do a proper audit. Okay, this is where the challenge comes. We normally take a financial statement and start doing the audit. Okay, it's not the way to do the audit. There is an issue. Okay, you will do what I would say an inefficient or ineffective audit. You will do an audit, you will perform, but you will do either an over auditing or a lack of focus on areas where there are risks. Okay, that's what will happen in an audit. Now, what can go wrong? To identify what can go wrong, you need to understand the environment in which the entity operates. Okay, because what can go wrong depends on the whole country. We had a demonetization, it affected certain industries. Okay, GST came, it affected certain people, or it affected the whole thing, either negatively or positively. Okay, there are industry specific. The government policies changes, competition is coming. Okay, so the competition, for instance, the automobile sector, we are talking of battery operated cars. It's a sea change which is going to happen. Okay, the government changes the pollution control norms every 4 years. So there are a lot of changes to be taken. You can't make the same engines, it has to be changed. Okay, like that policies effect. Okay, so if you have a business which is operating in say banking, finance, there are a lot of regulation which is happening. Okay, the regulation can change the way the accounts are prepared. The regulation can change the way the business operates. Okay, so the first thing we need to know, that is what the standard talks, I will go into detail, is to understand the environment in which the business operates. It could be a macro level and it could be micro level, both. Okay, believe me, in practice, you can never do an audit unless you know the business in which they operate. Half your audit is done if you know the client well. Okay. Now we're coming to micro level. At the company level also there are issues. For instance, a company can go public issue. The company is going to borrow money from the bankers. On the other hand, the company will be doing well. They want to reduce the taxation, so they want to understate the profits. SMEs get issue. Okay, they don't want to pay tax. They want to reduce the tax as much as possible. That's fair enough. Okay. So, but there is for us, for an auditor. Okay. If there is a normal risk of sales being misstated because of cut-off and other issues, in an environment where the client doesn't want to book, they may not want to book the sales. So, cut-off has to be careful. They might have sold it, but the sales may not have been booked. Okay. So, there are issues. So, issues could be different. So, micro level understanding of the client is also important. Okay, so this is what is the broad thing where we start. Okay. Now the process. So the standards, why there are standards? The standards ensure that the audit is done in a systematic manner and there is a consistency in which the audit is done. Because we are giving a report. So if you do the audit the way you want, I do the audit the way I want, and I give a report, that report cannot be reliable. Because the background of the work which is done could be much different, and your answers which you have arrived at could be different. Okay? So that is why the standards have come. The standards have come so that there is a standard up to which you can look at it. The standards are flexible in the sense they give you a broad indication. They don't tell you this is what you check, this is what you check. They tell you how to do the work, what is the process to be adopted, what is the documentation to be done. Okay, so that is where this comes, the process. Now, what is the thing when you do risk assessment on an engagement? Okay, now one of the things it says is, look, whatever information if you have got from accepting the client or by doing other work or from other sources, please make use of them. This is one part of the audit where the information need not be given by the client. We normally find that we also have the same issue with our auditor that we go to the client and we want the clients to give all the information. I said, no, not necessary. The risk assessment to start with, you need to have the information and go and tell whether these things are what the client is doing. Because the information relating to the environment is not entirely with the client. It is outside environment. The industry environment, the regulatory environment, that all is public domain. Okay, so the information to be used for this purpose of audit not necessarily flow. I would say initially, broadly, will not flow from the client. You need to make use of your independent information to understand the environment in which the client operates. The client also will have it. It's not that they will not have it because they are doing the business. You go and ask them what is affecting your business. You get a lot of knowledge. But you need to start before even going to the client. Okay? You need to go to the clients, you need to have a background to what are the questions you are going to ask the client. Okay? So that is very important. So here in this case, the standard tells you a broad indicator of what all the information which you should be using. Not necessarily going to the client and asking for the information. Yes, you will do that. Okay? So that's very important. The entity and for the purpose of understanding the entity, yes, you will get the information from the client. The information on the entity, it is not necessarily financial. Okay? It has to be a broad thing of how the business is operating, how the business of the company is doing. Because to understand what can go wrong, You need to understand what is the problems of the company which is facing. For instance, there is a cash flow issue, the sales are not happening, the company's sales are down. Means what? There could be problems with financial statement. It could be sales could go down, the profits could go down. Okay, so that's an indicator. And they could try to manipulate to retain the results if they have to go in for loans and other stuff. Okay, so to understand the business, it's very important. So the information is not necessarily only financial. It has to be a broad information relating to the clients, what is the business, how the business is operating, how the business changes happen from the earlier period to the current period, what is expected in the next period is also important. For instance, there is something which is happening. Because of that, the sales of a particular product is going to be discontinued for next year. That is a very important information for you, because anything to do with that product may need to be written down or written off. Okay, so the information on the entity could be past, immediate past, present, and even the immediate future. Okay, so it is very important we have a broad information from the client as well as our own research. Okay, not just financial. Okay, this particular part is quite interesting actually. If you ask me what is the thing which you done, the audit is slowly focused on certain businesses also nowadays. People are asking, when we had this rotation came in, the practical experience which he had, they asked us what experience you had in this industry. If I go and tell I have to sell myself, he said I want to audit. They ask what is your experience in this industry. Because the client itself foresees that industry is important. Industry is important because of the reason to understand the environment which the client operates. Industry knowledge is very important. So it is all the more reasons even audit is becoming specialized. For instance, somebody who does a financial sector audit, he cannot do the audit. Everybody cannot do a financial sector audit. A bank or an NBFC, unless you are thorough with the regulations of Reserve Bank of India, which goes on changing. Okay, and also the risks under which they are operating. Okay, so to understand the risks and industry knowledge is important. So even specializing audits in industry is becoming norm these days. Okay, designing further audit procedure based on the risks, you do further audit procedures, reconsider and revise the risk assessment on an ongoing basis throughout the audit and look at it towards the end also. What happens is when you start the audit, you may not have all the information. Okay, subsequently when you are doing the audit, you may get more information. Okay, so the risk assessment which you have done in the beginning, based on which you have planned your audit, could change because of the additional information. So you will need to revisit your risk assessment at least a couple of times during the audit, whether my risk assessment needs update. Okay, and then we conclude, because that is one of the things which we miss out. We make a plan and then execute a plan. Planning is not cast in stone. Planning is a dynamic process. Planning has to continue till the end. The financial statement is signed, because many information you will find only towards the end. It's all fine that the client has to give all the information, but you will find the last minute only you will come to know certain things. Okay? So it is necessary to go and revisit the planning and the risk assessment throughout the audit. Okay. Well, see, these are all in the standards. I am not telling anything about it, whatever I mentioned. Okay, understanding the entity is very important. Now, industry, regulatory, external factor, including applicable financial reporting. For instance, whether the company has to adopt Ind AS or not, you have to go to tell the company. It is not an internal matter. You should be clear whether they should follow Ind AS. Okay. For instance, the banks and NBFCs. For instance, one industry we are still this year. For instance, NBFCs, whether they should adopt Ind AS or not. How do they adopt Ind AS? I would say it's such a confusing thing. Reserve Bank of India has got guidelines which they have not withdrawn, and the Companies Act, Ind AS has kicked in. Reserve Bank has not come out with any clarification. So every one of us are doing certain way we are doing. Okay, it is very sad state of affairs, and tomorrow something goes on, the Reserve Bank will harm the auditors. Why didn't you do it? They have failed to give a proper guidance as a regulator. Everyone is following what they think. For instance, if I follow Ind AS, my provisioning may go down. Can I reduce the provisions? Don't know. Okay? So, we are actually following a hybrid method. For instance, personally, I follow a hybrid method. Whichever is more prudent, you follow. I tell the board. I said, they have not come out with the guidance. So, there are challenges. Regulatory regulations is not clear in preparation of financial statements. Something which is, what is the accounting standards to be followed for NBFCs is actually not clear in this year. Okay, they are preparing the financial statement, we are auditing. I can tell you at least 2-3 different types of things is being done throughout the industry. Okay, tomorrow something will go wrong, we will blame the auditors. Unfortunately, the institute has failed to go to the Reserve Bank and tell, look, we want concrete thing, otherwise we will not be able to follow. Reserve Bank has not come out. So this is happens. This is what I am telling you is applicable for all the NBFCs which you may be auditing. Which standard to follow, what to do. Normally we were all following Reserve Bank of India guidelines. Those who are doing bank audits will know. Fortunately for banks, it will be deferred because they have already asked for it and the banks have told you don't want to do this year, next year. But NBFCs, they have not come out with the guidelines. Okay, so we are going to be there. We are in that framework. As important as what is the framework to be followed is not clear. This is the risk. So if you are doing an NBFC, you factor this risk. Okay. Now, nature of operation, ownership. Ownership makes a lot of difference. Whether the company is a owner-driven company, the risk involved are quite different. Okay. If there is a owner-manager, okay, normally you will find that the controls may not be so much operating, but there will be a lot of oversight from the management or the owner manager. He will approve all the payments. So he will come and say, what's your problem? I am approving everything. Okay, but there won't be any segregation, there won't be anything on internal control, there will be a lot of issues. Okay, in fact, Institute has to come out with a guidance, interpretation of the guidance note on internal control over financial reporting for SMEs to state that, look, in the smaller enterprises there will be issues on control like these kind of things, but it will be compensated by oversight. Please look at that. Okay, so it is important, the ownership is important. Okay, if there is a listed entity, the risk involved is different. Okay, listed entity and quarter they have to give the results. They have to tell the investor what has happened this quarter, why it is lower or higher. I can tell you in practice, it is a big challenge. They will say, no, don't do this, I will do it next quarter. Okay, this quarter review is not there anywhere else in the world, it's there only in India. There are quarterly results are there in many of the geographies, but there is no review by the auditors. Only in India, review by the auditor is mandatory, and that puts a onus on us. So that it's not only the yearly accounts, it's the quarterly accounts are important. Okay, quarterly figures are important based on which transaction takes place in the stock market. Okay, ownership is important. Size, complexity. Okay, if it is a simple operation like I told you, cost plus operation, it's simple. Okay, the risk could be much lower. Whereas if it is a complex, for instance in financial sector, somebody is buying and selling derivatives and all. Okay, there is a lot of complexity. Even the work which you are doing, you are undertaking a lot of projects which have a lot of uncertainties. Somebody is constructing the roads. It's a lot of complexities involved. You need to get so much of approval. You need to get the land. You need to get various things clear before you constructing the road. Okay, so it's a complex operation. The projects are complex. Okay, complexity is involved. And types of investments of the entity, that's also important. For instance, many times a company will be an investment company, there will be nothing, only investment sitting there. Like one of the companies which is in the news, it's similar things. There is a company which has got so many subsidiaries. The investment in subsidiaries could be complex. It could be a joint venture with someone else. It could be the entering into projects of different kinds. Okay, so each of those subsidiaries may be complex. Okay, so that is important when you are looking at the risk assessment. Okay, selection of accounting policies, as I told you, NBFCs, if you are doing the audit this year, selection of accounting policies is a risk. Okay, because the framework in which the accounts have to be prepared is not clear. People have taken a call that India is applicable, I am preparing. Now what happens to the Reserve Bank tomorrow, next year the RBI will do inspection, my thing is not followed every time. Okay, because they have not come out with a clear guidance. They don't want to take a call. Okay, they want to wait and see what happens. Okay, so it's important complexities of accounting. For instance, Ind AS has come. Interpretation of certain standards in Ind AS involves judgment. Okay, valuation is important, whereas if you have a fair value standard, fair valuation is involved, it's complex. Okay, so most of the things, accounting is based on fair valuation. Fair valuation is an opinion. You can differ from the opinion given by a valuer. Okay, so there is a complexity involved, there is a lot of judgment involved. Okay, things can go wrong. Okay, for the same investment, you could get two different valuation and two different valuation principles. Okay, for instance, we did it. We had a thing in Indian GAAP to Ind AS, same investment were valued differently because the valuation accounting principle was different. Okay, so it's important, complexity is important. These are the things which you need to look at it at the beginning of the risk assessment. Objective and strategies and those related business risks. This is very important. As an auditor, why am I to bother about the business risks? As I told you, the perception now, we are actually being brought out with all the business failures, the auditors also failed. That is the perception which Ram Nisham is very much bothered about the topic, is that we are being judged by perception, not by what the work which we are supposed to do. That is what is happening. So, we need to understand this business, can the business fail? How is it going to affect the financial statement? As I told you, we need to know about the future, what's going to happen in the next future. Okay? For instance, if there are going to be, for instance, many of the businesses have become a thing of the past. For instance, when Amazon launched the thing, they wiped out the bookshops in US, lots of bookshops. I went to US and I had a photo, crazily, I went to an Amazon bookshop. So somebody who came with me, he said it's ironic. They destroyed all the bookshops, but they have come out with the bookshop on their own. Okay? So the way e-commerce is doing, for instance, e-commerce at some point of time, all the mobile shops closed down. They again revived. They revived. And if you go to many of the shops, it says that my pricing will be on par with the pricing which you do in an online business, online thing. There are. If you ask him, you go to a shop and say this is available at Amazon or other shop at this price, will you give me? You will be surprised. Most of the time you will get it at that price. Okay? So the way the business is being done has been changed a lot by this e-commerce business that's happening. Okay? For instance, the way taxis are run has changed, the way Uber and Ola has changed. Okay? So, in fact, they have not gone full-fledged. For instance, Uber in other countries, it's not the taxi operator who operates an Uber. You and me can be an Uber driver. Okay, whenever you are free for half a day, you can log in and then you can go and operate as an Uber driver. In India, it's prohibited because you need to have a taxi license, you need to have a commercial license. Okay, but the way they have affected the others is phenomenal. Okay, like artificial intelligence. It's going to change the way the businesses and the way the audit is being done. I'm not looking at it. It's going to change drastically the way everything is happening. For instance, the processing of data. We have seen the processing has come to India. We have IT-enabled services here, but the way IT-enabled services is going to function in certain things is going to change drastically in the next few years because of artificial intelligence. What is being done by human beings is done much faster by what you call as bots. We call it robots. Okay, even it's a software robot. There is nothing physically there. They can change the way processing takes place. It takes 5 minutes or 10 minutes to process an invoice. They will process 10,000 invoices in 1 minute. Imagine what will happen. It's going to change. The way the business is going to, and everyone will go in for that, because unless you go in for that, you will not be competitive. Okay? So that's going to affect your risk assessment. Okay? Then contractual commitment, competitive benchmarking, use of external analysts, all could be there. It could be environmental loss. For instance, the thing which affects a going concern very drastically, if your company is involved in production, pollution control norms is the only one which can actually come and close a factory without the notice. Sterlite factory in Tamil Nadu was closed by a pollution control board notice, period. They are not even given them opportunity. They have gone to Supreme Court. Supreme Court is saying you open it because you have not given them the chances. You have not told what was wrong. But they have closed it. Every state, the pollution control norm, pollution control authorities have powers to close the factory. So even that affects our audit. Whether they have got a pollution control board clearance. Even pollution control things, clearance is needed even for housing projects beyond a particular number of units. So what affects the financial statement is pretty wide. So risk assessment, you need to go into the details of understanding them. How it affects the financial statement, this is where we are going to come. But we need to have knowledge. Okay? The next aspect of the risk assessment is to understand the internal control system. Now, we have got all these risks. Now, we need to identify these risks which affect the preparation of the financial statement. What are the internal control systems within an organization which ensures these risks are mitigated? For instance, if there is a risk that a particular product can go away because of business reasons next year. Now, is there a system within the company at the end of each period which looks at what are the things which are going to happen the next year? Because of that, my valuation of inventory has to be looked at. If there is a system, there is a proper internal control system, you can rely on them. They would have done an assessment. How will I sell this product if the product is being discontinued? Okay, or there is a system to ensure that there is a discontinued list of products and what are the raw materials which are needed for the discontinued product that are all written down to realizable value. That's an internal control. Okay, so each and every aspects which you have identified as can go wrong, you need to identify the internal control. This is where these whole audit is come from. What we say, like we were identifying risk in our firm. Now what we realized was the risks were identified at a broader level. Okay, cut off. Sales can be understated. That's the risk you identified. But it's not of much use. How do you convert that risk? Because you are supposed to not just identify the risks. Okay? If you identify the risk and don't do anything on it, you are choked. You are negligent galore, grossly negligent, because you know something can go wrong. You identified it, but you don't do anything. So you need to identify the risk and you need to ensure the risk is mitigated. So for that purpose, you need to identify the risk at a granular level. Okay? So nowadays, which you are insisting, regulators who inspect PCOB, they are all insisting, look, it's not enough you identify risk in broad term. You need to identify risk at a granular level. What specifically can go wrong? Okay? It's not that sales can go wrong. Is it a completeness of sales? Or is it an accuracy of sales? Or is it a disclosure which can go wrong? So you need to identify specifically, or all sales can not go wrong. A particular kind of sales can go wrong. I may have I may distribute through my dealers. I can sell it to my customers who are industries on a business to business. So that cannot go wrong because of B2B. Okay, something which I do with the dealers which I have control can go wrong. Okay, so you need to go into the granular level and also specifically identify the risk. So you identify the risk broadly. You go down to the assertion level, that's what is needed as per the standard. Assertion means a particular Any item in the financial statement has got various assertions. For instance, if there is a sale, the company is saying this is a complete sales. These sales are actually occurred. Okay, the value of the sale which is stated is accurate. So these are for each assertion could be different. Assertion could be slightly different based, is it a P&L item or a balance sheet item or a disclosure. Then these are all standard there. So you need to go and identify the risk to that level. Okay, when I am looking at say year-end sales, am I looking at the completeness of sale? Not necessarily. Because the client, if he wants to oversell the sale, he will ensure all sales are booked. That's not a risk. Okay, it could be a risk if I identify that the company wants to understate the sales because they want to reduce the taxation burden. Then completeness of sales could be a risk. Okay, but normally if you identify the risk as overstatement of sales at cutoff, you have to identify that risk accuracy of sales at cutoff. Cutoff is the risk. Even cutoff, you need to identify more granular level how you can change. Okay, how they will do it. You may have to go down and check it and then document it. Okay, then only you can identify what will you do to mitigate it. Because what will you do to mitigate has a specific audit step. Okay, here before doing what will you do, you are looking at the control. What is the control which is existing which mitigates the risk? That has to be a granular level. For instance, you identify the sales. Sales could be booked without dispatch of material. That could be identified as a risk. Now, for that particular risk, what is the control? What is the control which is there in the company which ensures the sales do not take place or not accounted for without dispatch of material? Okay, when there is an invoice, someone checks it to ensure the goods dispatch is there, goods are dispatched, then only is invoice generated, and that after that only an invoice is booked. There is a control. There could be a proper control in this thing. For identifying that control, you need to identify the risk at a granular level. Okay, this is what is happening in the recent times internationally, and it is because everyone was identifying. We had a classic thing, risk. So it's like pick and choose. So I have 15 risk for a sale. Somebody will pick it up and put it there. Okay, they said no. This is not the way it is there in the company. So you need to identify it to the company. Okay, so that's what is happening, and it is necessary. It is necessary because you need to mitigate the risk. You need to identify at a granular level. This is where the challenge is coming. Practically, if you ask me, we have a challenge. My colleague is here. He can tell you. We take our brains out to document in English. English is important. People will document something different from what they understand. Okay, it's a challenge. Okay, they will tell you something what you want. What they have documented could be opposite. So you have to be careful in writing because everything has to be documented. Okay, so risk assessment is the most important documentation because all the documentation follows the risk assessment. If you ask me how the documentation flow should be, you have to identify the risk, you identify the control which mitigates the risk, you test the control and then conclude on internal control. Based on the internal control, for the same risk, you identify what are the substantive tests you will do. Okay, and then again the test details and conclusion of the test, and then you need to conclude. So everything which you are going to document will follow risk assessment. If your risk assessment is wrongly documented, everything else could go wrong. Okay, so it's not Greek and Latin, it's common sense. People say common sense is not common. Okay. So this is very important. See what we find in practice. The standard says you should look at the internal control system. Believe me, 8 out of 10 times the documentation within the company on internal control system is not perfect. They will do everything, they will not have a documentation. Okay? Very often, first year if you are doing an audit, we have gone through this process. Because of rotation, I can tell you the amount of time we spent is humongous in documenting the system. Because whatever there are very few companies who are say listed abroad or anything like that who have the documentation perfect. because they are responsible, the board is responsible. In India, the board is responsible for internal control system. They will have, by and large, good internal control system, but it will not be documented adequately. Okay, so that is very important. So, because it's important, documentation of policies itself is an internal control process. Is it documented? Because if it is not documented, if there is a change of guard, change of people, which is frequent, the guy who comes will do things as he understands what is to be done. So that is a weakness in internal control. Okay, so for that purpose, a documentation is important. For instance, we create a risk control matrix. The companies had risk control matrix. So I had to actually give the risk control matrix to the client, telling them, look, these are the changes you need to make. We actually gave it to them after the audit. Because your risk control matrix is not properly done. It's all there. I can tell you the company has got perfect internal control, but it is not being documented properly. Okay? So because the risks have not been properly identified, or languaging is not correct, okay, the controls are not put in correctly, because controls, there are challenges which are coming. We put things, process as a control. Okay, if something is happening in the company, it's a process. Now we need to identify whether a particular process is a control or it's just a process. Control ensures to mitigate certain risk. Okay, that has to be documented. So very often the documentation is not proper. Okay, so we have done that. We have done in big companies, and I'm sure SMEs, most of the companies will not have documentation at all. So it's very important. We can assist them to recreate a document and give it to them. Okay, we cannot write the control documentation for them, but whatever we create, we charge additionally as a part of auditor and give it to them, because anyway the documentation of their control system. Okay, so it is important the controls are documented. Based on the documentation, what you are supposed to do is a walkthrough test. Walkthrough is walkthrough. Right from the beginning to the end, you walk through with a couple of samples. Okay, and test whether what you have documented is correct. Okay. So the controls are, what we are interested in controls is the way it is designed, that is one. The second, whether what is designed is what is operating. So if you go to the internal control or financial reporting, that's what has also come. So what is designed, the control has to be designed properly. There could be a design failure. Okay, means whatever you have designed is not adequate control to mitigate the risk of a material misstatement. Okay, that's a design failure. You might have designed it properly, but it may not be operating effectively. I told you a simple thing. There will be somebody who will say, someone has to review the bank, simple thing like bank reconciliation statement. I will just, is bank reconciliation statement preparation, is it a control? This is a classic example I ask.
Yes.
Is it a control?
Yes.
Yes. How many say no? So this is only one or two. Okay. I tell you, this is a classic example. Preparation of bank reconciliation statement is not a control. I'll tell you why. You prepare a bank reconciliation statement. There are hundreds of items where the entries have to be passed. By doing a bank reconciliation statement, do you think the entries will be passed? Huh? So bank reconciliation statement is a process which enables a control. Okay, so this is where it comes. Okay, I'll just give an example of a process and a control. Review of the bank reconciliation statements and pass appropriate entries arising out of the reconciliation. That is a control. Is someone doing that? Is there a control that someone reviews the bank reconciliation statements, and based on the bank reconciliation statements, what are the entries to be passed, whether those entries are passed? That is a control. Okay? Otherwise, bank reconciliation statement is just a process. You can follow bank reconciliation statement, you can have a reconciliation statement, items outstanding for 2 years. It will be there in the bank reconciliation. Perfect, statement is prepared. Nothing happens. What use is the bank reconciliation statement? It's not of use, it's just a process. Unless the bank reconciliation statement is reviewed and appropriate entries are passed arising out of the bank reconciliation statement, that is the control. Okay? I can tell you 9 out of 10 times I interview people and ask this question. In my own thing, my own manager will not get it right. Balaji is there, he will tell you what to think there. Okay? When we have our own internal inspection, this is a big thing. They will say this is not control. Okay? So this is an area which is recent for the past 5 years. It attracting attention. In your ECOB has come out with various things. So people are documenting processes, controls. It's true. It's just a common sense. Because we take the things for granted. The moment a bank reconciliation statement is prepared, we assume that we are preserving proper entries. It's not. You can't assume things. It is only the important steps towards a control. Okay? So that is the challenge. That is the difference in control and processes. Okay, I just gave you a simple example which is actually very wide. I can tell you when we started doing it, almost every audit we changed the documentation, saying that no, don't document this way. Okay? People have gone further, ECOB has gone further. Okay? Whether the person who is doing the control is capable of doing the control. They have gone one step ahead. Someone reviews it and then puts it. If the guy doesn't know what is the difference, okay, something is outstanding for 2 years, what should be done on that, there is no point the control will work. Okay? So they say when your operating control is there, whether the control is operating effectively, we need to look at it, who is operating the control. Whether the person who is operating the control is capable of performing the role which he is supposed to perform in the control process. Okay? So these are the finite, what is called things which we are finding in problems in internal control, especially in medium and small enterprises. Another important thing which we have an issue with small and medium enterprises is segregation of duties. Are you aware of segregation of duties? Anyone aware what is segregation of duties? Yes? Maker checker. That is one of them. What else? Suppose I have got a purchase, I have got payment, I have got ordering. Everything can be done by one person? Yes? Can someone authorize an invoice and come and authorize a payment to the invoice? Is it segregation? No. Segregation of duties is that conflicting components of a particular process should not be done by the same person. It should be done by persons who are independent. Okay? If you want to take a very fine level, the guy who is reporting to somebody himself should not do the control. It should be somebody independent of that person. Okay? For instance, a person who is physically, the company has a control of physical verification of inventories. If the guy who is in charge of keeping the inventory, can he do the physical verification? This is a normal thing which happens in most of the companies. He cannot.
Storekeeper does the physical verification.
That is not a control. Okay, because he is responsible for the physical verification, he is responsible for the movements of the good. So if suppose he has, pilfered certain things, suppose you are an industry consumer which makes shirts. Okay, it's a classic example. You can easily take away the shirts. Or he is in commodities which could be easily sold. Okay, so he can take away and pass fudging entries and show the stock. And when the physical stock verification, which is a control, if he himself does it, can it be proper? It cannot be proper. He can help someone to do the physical verification. This is a classic thing which happens in most of the companies. So when you go there, just a practical thing, if someone goes and comes out a physical verification of inventory, there is no difference. Okay? I can bet 100% there is something wrong. Unless it's something very item where it can be counted, none of the physical verification can be perfect in the sense book stock cannot tally. So what would have happened is, the guy who is in charge of stores would have done a physical verification himself. He would have passed all the adjustment entries and he would have ensured that the book stock matches with the physical stock. Okay? So what as an auditor you are supposed to do? You have to go back and check all the entries whether they are properly made, and if it is significant you inquire why is this variance, is it a proper or not, Okay, you need to do that. Okay, so that's the fine points in respect of controls, processes, people doing the control. Okay. The other important thing which we've come across now is manual versus automated. A lot of things are now automated. When you are automated, okay, so there are good things and bad things. Because it is automated, somebody cannot pass an entry manually, okay, because it is produced from the systems. Okay, for instance, many of the finance companies and banks, interest calculation is automated. It is good in an aspect because no one can interfere with the system and pass entries. If you are passing an entry for that, that could come as a journal entry. Okay. Now, mere automation is not enough because we don't know what's happening. So, automated system need to have automated controls. Okay. So, those controls we need to identify. The first step is what we call as general computer controls, because if that is very, very important. One of the things which our team does in the thing is there someone can go and alter the program? Is there a control over alteration of changes made to the program? Okay? They say if there is no control, in fact we had landed up with systems which were developed 10 years back, which doesn't give a log of the changes made. They say there is no computer control. You cannot rely on automated control. Period. That's the level at which you're going. What they are saying is someone can go and change the system. You don't have a log of the system. By changing the system, you can manipulate the results. You will not come to know. The entries will be passed because the program logic produces those entries. Okay? So the program logic could be changed. Okay? There could be manipulations. So this is an area of challenge. You need specialists. You need specialists who know IT. First, there are two levels of control which are important. One is general computer controls, which many of us know what is the thing, physical control, logical access, so many things which are involved, whether they are there, and then specific relating to a particular process. What are the controls which are there specifically? Okay, so there is a control that interest is calculated based on the outstanding balance and the number of days and the interest rate which has been input in the system. There is a control there. There is a logic there. You can test the logic. Okay? So that is an automated control. By and large, automated controls are more reliable if they are working well compared to manual controls, because manual controls is dependent on a manual entry and intervention which may not be repetitive. It depends on the individual. Someone who is supposed to do that, you can test it, but whether he has done it or not, you don't know. He would have signed off without doing it. Okay? Even that has come in. That PCOV report they asked. He said, you tested that somebody has reviewed the bank reconciliation statement, there is a sign off. They said, did you go and check what does the sign off mean? Did you go and check with the person who is signing what he does before signing off? Because they realize, and it is true, most of our cases, somebody goes there without looking at it, he will sign off. So the sign off doesn't mean the control is operating. So that's the conclusion there. So nowadays PCOA, we make a thing, what he does, he actually is put in the system, or we check and go and ask him what he does and document, yes, he is reviewing it, this is what he does, this is what he do, all those things. Okay? So it's important. So manual control, there are chances of failure, more chances of failure compared to automated controls. So we believe, as this is what is the current position, if the automated controls are working properly, they are more reliable than the manual controls. Okay? Because they are consistent on a repetitive basis. Whereas a man cannot be consistent on a repetitive basis. He could make mistakes. Okay? He could make more mistakes. Okay? So that is important. Again, there is another thing called preventive control or detective control. Preventive control is basically prevent something going wrong. You can just put it there. Detective control actually detects if something goes wrong. Okay? For instance, if specific items, for instance, payments are made, at the time of making payment, it is ensured the goods have come in, they have been accepted. That is a preventive control, because you will not make a payment. Before payment is made, it is prevented. Whereas The reconciliation part of it, after it has happened, you make a reconciliation, identify certain things, if there are certain things, you take action, you detect if something has gone wrong, something is not accounted for. So it could be a detective control. Okay? So it's both could be there. Okay? Preventive controls are always better, it prevents something going wrong, but detective controls will be there because all the time you can't have only preventive controls. Detective controls by and large is necessary, especially in preparing financial statement. A lot of reconciliations you will find. All reconciliations are basically detective controls. Okay? Non-availability of documented policies I looked at. Process level control at small entities. Okay? Looking at the small entities, there are certain issues. Now there are things, by and large, I would say, is it a owner-driven company? There are issues of getting adequate personnel. You will find there is not much, the people who are preparing financial statement may not be experts in accounting. They may do bookkeeping, they will not be able to prepare financial statement. There may not be segregation of duties appropriately because the number of people who are working there are less. Obviously, you cannot have a segregation. If I need 4 people, I will have only 2 people or 3 people. They will be doing the work. So, well, it is recognized, it may not be there. The standard itself says segregation of duties may not be there in smaller enterprises. But you need to ensure that there is a proper oversight mechanism which mitigates the lack of this control or weakness in this control. That's very important. Okay? Is someone else who is looking at it carefully whether because these people are there? Very often Indian companies, owner-driven companies, the control lies in signing checks. The owner only signs checks. Okay? Not even small. I audit medium-sized company. The owner says, look, what's your problem? Everything is approved by me. Okay? Well, there is no problem on this, but we have a problem in smaller enterprises. I think that a very important thing which we need to look at it and we need to document it. In smaller and medium enterprises, what we call management override of controls is predominant. The management can override anything. Suppose you have a company which owns 80% or even 100%. Okay, he is the manager, he is the managing director. Tell me what kind of internal controls you can rely on. You can have internal control. In fact, I tell the institute you should have never made mandatory internal control or financial reporting for these companies because you damn well know if there is a owner-driven company, internal controls may not be relied upon. So why? There will be controls. There will be control depending on the type of business. Suppose you have a company which operates restaurants across India. Obviously, the owner will have proper internal control because he cannot be present in all the restaurants. Cash component is involved, cash sales are there. So he will ensure that proper controls are put in place. Okay? But it is not necessary if the sales takes place only from his factory there. So he will decide what to do. Okay? He will decide what payments to do. He will decide how to fix the salary. So a lot of management intervention could be there in a small, medium enterprises, especially owner-driven companies, mainly over. Okay? So management override of control is a recognized risk. Okay? Because all the frauds which took place, 100%, then mostly there was a management override of control. You will have a system, big companies also. You will have a system, it will all work properly, but there will be some management override which would have suddenly been there. Okay? They would have even overriding automated controls also. So management override of control, by and large, in most of the audits, bigger audits, it has been treated as a perceived significant risk. It's a default significant risk because none of the controls can mitigate that risk of management override of control. Well, how do you mitigate the risk of management override of control? Believe me, it's a big challenge. It is a big challenge. Okay? So the amount of work which we do on management override of control is phenomenal. Okay? So we need to check, for instance, all the journal, if there is any entry which is passed, it has to be through some normal route. So what this says, standard and non-standard entries, that's what the standard talks about. Standard entries which are passed in the course of business without any intervention, any management overall, and then by and large there will be a non-standard entry. Okay, you may actually book a sale through a JV. Okay, you may provide something, you can reverse a provision through a JV. Okay, you can pass entry of a rebate. Okay, you may have a rebate which is passed in the system, you may reverse the rebate based on the journal entry. So what has happened over a period is, there are various things you need to do. One of the important tests is to check thoroughly the journal entries. 100%. You check the journal entries, identify what is standard and non-standard, all non-standard entries, please go through it. There is no other option. There is a lot of work involved. Okay? And this is a big risk in small and medium enterprises. Because the risk of management role is quite high in an owner-driven company, because everybody reports to him. Whatever he says, they pass. They don't exercise independent judgment. Whereas in a bigger company, management override will be at the top level. There could be mitigating factors like your board, your audit committee, independent directors, all those things. Whereas in a smaller company, it's a very high risk. Okay. Even in bigger companies, management override of controls will be there depending on the situations. Okay. But by and large, it's very high in medium enterprises, especially one or two companies. Okay. This is important. As I told you, audit is one of the major portion of the audit when we are looking at the audit is done properly or not. Whether the assessment of significant risk has been done properly and it has been addressed properly. Even a QRB review, everything, they have been asked to focus on that. All regulators who are inspecting, they are supposed to focus on that. Whether the significant risk has been identified properly and it has been addressed adequately. Because significant risk is significant risk of material misstatements. If there are lower level of risk, you cannot mitigate all the risk. If you have identified a risk as a lower risk, if you have not done something, you may get away with it. But if you have identified as a significant risk, okay, the process of identifying the significant risk, whether you have identified properly and you have addressed it properly, is the most important part of an audit in practice also. Okay. So what are the things which could be there? Risk of fraud, significant economic indicators, accounting indicator, complexity, significant related party transactions. This is of late has taken a lot of attention by regulators, public, everyone. Because related party transactions, by and large, can be manipulated because you are related. The pricing could be fixed. Even without sending the goods, you could book sales. Because it's a related party. You have control over the related party or they have control over you. Okay? So, related party transactions, even in Companies Act, a lot of attention is being given on related parties. Okay? Simple thing like transfer pricing. Transfer pricing came in because of related party transaction. Because they felt that group can pass the profit to a geography where the taxation is the lowest and reduce the profit where the taxation is higher. Okay, that's how the transfer pricing came. Same way here, internal transfer pricing we have now. So that you can pass the profit from one entity to another entity because of the taxation. Okay, so related party transactions are focused a lot because it need not be at arm's length. The risk of arm's length, not at arm's length, is very high. Okay. Significant transactions that are outside the normal course of business for the entity. That's very important because anything which is significant, which is done outside the normal course, could be one-off transaction, the risk could be higher. Okay. SA 330 talks about how do you address what is the response you should have for the assessed risk. All are common sense, okay? Nothing which you can't understand. First thing is have our significant risk. Ensure that your experienced staff is done in doing that work. Because I cannot identify a significant risk and a junior most person and does that work. It will not work. Okay? It's specifically stated, assign more experienced staff, experts. If it is complex, make use of experts. If there is a valuation report, if I do not know the valuation, how the valuation is done, please take care of valuation. If there are tax issues, If I am not a tax expert myself, please make use of a tax expert and get it reviewed. Okay, so that's what the guidance which is given in the standard. Make use of the experts. Okay, widen the scope of audit. You can increase the sample, you increase the type of test which could be done. Okay, change the nature and timing. Okay, basically if you feel that people are fast, they do a surprise check. Okay, you could change anything. Okay, so it's very important you look at it carefully, use your judgment to test. Okay, in significant risk areas, incorporating unpredictability in your checks. This is very highly, very difficult to use practically, but it's very highly put in. Unpredictability has to be there. Okay, what happens is basically the client should not know what you are checking into. Okay, suppose if they come to know that this is how you select the sample, they will be prepared for it. They could be prepared for it. Okay, suppose you go and check, okay, last 2 days I will check for cutoff. They will ensure last 2 days is perfect. Okay, so you go and check about 10 days before the year end. It is possible. Okay, clients are also smart. Okay, they are smart. So the standard says you please have unpredictability fitted into your system because that's what will be effective. What is unpredictable? Could be surprise check, change the nature of the samples is selected, change the timing of the test which is being done. For instance, if you are doing physical verification at the year end, you may test check subsequent to the year end also, or 15 days before the year end, go and check it. Okay, so it could be there. So all these things, you need to demonstrate that if you identify something as a significant risk, you have done something additional than other areas where you identified a lower risk. Because if you have identified a lower risk and you say this is what I will do as an auditor, you cannot go and tell if it is significant risk also I will do the same procedures. Okay, this is very important. So this is where the risk assessment comes. If you identified significant risk, you do work more, focus on them. If you have identified a lower risk, you could do lower work, lesser work, or you can exclude it if it is totally not significant. Okay, so that is where the risk assessment is very important. Very often we have been questioned on that. This significant risk area, what did you do differently? They will question us, somebody internally inspecting or quality control. He said, look, these are the things you normally do. It is a significant risk, what did you do additional? Okay, so it's a challenge. I can tell you in practice it's a challenge. Okay, so we need to identify that I focus more on significant areas. So it's very important. Nature, timing, audit procedures, these are all very important. Okay, this is a granular level what you could do. Okay. So we have just given an example of what are the things that standard itself has examples of what could be there as test of controls. Okay. One of the things which we are focusing as a profession with things is to involve doing a lot of analytical procedures. Okay. What is analytical? It is there in the standard, but it is not elaborate as there because the standard setters have still do not know how analytical tools have evolved. For instance, if you are doing a finance company, you could actually take the entire data and recompute the interest itself. You can actually recompute the interest itself with something like Excel analytical tools, Excel tools. You can easily do that. Unless interest is complex, there is a lot of various interest types. Okay, so recomputation has become very, very significant. Or the analytical tools have made it easier now to test the whole population instead of samples. Suppose you have identified an error or you have identified certain thing as a risk, you could actually take the whole population and do an analysis to identify is there any exceptions in the whole population. This is evolving. This is not there in the standard. I can tell you 5 years down the line, the way we are going to do the audit is going to change dramatically with analytical tools and artificial intelligence. Okay? It will become a necessity also. For instance, if there is a board which is doing the processing of my payment, how will I check it? There is no documentation, there is no trial. The board is programming, it is supposed to compare the invoice with the goods received note and the purchase order, and he will pass the payment. Don't think I am telling something which is some fiction. It is happening. Okay? It's happening in many of the entities, shared service center in Bangalore. These things have started happening. Okay? Now how will you check whether the process, what is the control, whether the payment is done correctly? Because there could not be any trial. Okay? So we need possibly boards to do audit in future. You need to create your own board, redo the same thing and check whether it is done properly. So the way we are going to do the audit may change, will change in the next 5 years because of necessity. Because we will not be able to test. Even with automated controls and all those things, we may not be able to test sometimes. Okay? So we may need to do artificial intelligence, use them. Okay? Like one of the things, simple thing which will hit you in doing this thing is GST and network. Possibly in the next couple of years, we may be actually using the GST and data for our audit purposes. Because GST and network is an external confirmation of the transaction which has taken place. Purchase as well as sales, that external party and that unless it is related party. Otherwise, there is an external party who is confirming in the GST and network the transaction. As an auditor, for the first time, you may be actually having an external evidence of sales as well as purchase. When you send confirmation, you normally send confirmation of a balance. Now you have got a confirmation of transaction in a GST and network. Okay? So this could be an enormous change which could happen in the next couple of years. I'm sure everybody is working on it. How do we make use of it? There are issues, challenges because you can't independently access it. Okay? So this could be a very new way of doing audit. Okay? Like that, analytical tools, it's basically very useful. The other thing which is there, control over IUC. This is another thing which is of past few years we have found it. Okay? Information used in control. There is another terminology which is there, it's called information, IPE we call it, information provided by the entity. IUC is what is the information used by the entity in performing the control, in the internal control. IPE is the information which they provide to you for your testing. Okay? Both need to be tested. Okay, whether they are accurate, what is the control in IUC information which is generated. For instance, I may generate a report. Based on that report, I may do a reconciliation. Okay, that report which is generated from the system could be IUC. Now, you need to ensure that IUC is properly generated because the control is dependent on that IUC. Okay, so these are the final points of controls as well as audit. For instance, IPE. They provide you with some reports and you use the report for your audit. You cannot rely on that IPE unless you have done some testing of IPE to conclude it is reliable. Okay? So these are the things which are coming, very final points which are coming in the past few years. Okay? We, for instance, Indians, as we in India, we are so much we rely on whatever is the report which is generated from the systems. Okay, you go to anybody, suppose if there is a report which is generated by the system, what is your gut feeling? It should be correct or wrong? What's your gut feeling? Huh? So the auditing standards or auditing, you need to be, you need to have at least it could also be wrong. Okay? Need not be pessimistic, but you need to ensure that the auditors has to be skepticism. Audit skepticism is what auditors are beaten down throughout the world now. You should have created this, should have created skepticism in your mind. You should have done additional procedures. Okay, so you need to be skeptic. So auditor cannot rely on any generated report. If you rely on it, it's your funeral. Okay, because you don't know how the client produced the report. Any report could be fudged to give a report. So you need to go to the how the report is generated, the logic, or test the report yourself. You need other corroborative evidence to ensure that the information they have given you is correct. Very simple thing I can tell you. If the client gives you for inventory, okay, the goods which have not moved for the past 1 year, this is a report which is generated. What will you do? You will take the report and ensure whether anything which is more than 1 year there is appropriate provision is made with it. That's what you do. Now that should be done. But before doing that, have you checked the information that which they have generated and given it to you whether that is correct? Okay? If that is not correct, then your whole process falls. Because the report based on which you have done a testing itself could be inaccurate. They could fudge the logic. Instead of 1 year, the logic may say 3 years. And you will generate the report and give it to you. There will not be much. Okay, how do you check it if it is 1 year or 3 years? So you need to test what is given to you. So the auditing has actually evolving. This was not there 15 years back. I don't know, when we started, we were questioned everything that the client gave. We said, look, we have to rely on the client, we have to based on that you have to do, but they are saying, no, you can't rely, you have to be skeptic. Question everything. Everything can go wrong. Okay? Okay, this is a smaller entry, there is no control documentation and process. So what all could be done? Okay? My suggestion is you charge extra, you document the system, give it to the client. Okay? It's good, client will pay for it. If they are quite happy, if they have some system and the documentation is missing, I'm sure they will pay for it. Okay? So these are the timing and the extent which is influenced based on various factors. Nature of the risk, nature of the audit procedure, effectiveness of control. The timing, when do you do the test? For instance, if you are doing an automated control, I think this is very important, you must do it before the year end. If you do it after the year end, it is not reliable because there could be changes after the year end. Because you are testing the control which was existing during the financial year. Okay? So believe me, I have a problem, I had a problem. People would have gone and done subsequently. We had great difficulty in proving that subsequent the date which they have tested it, there is no change. It was the same as the earlier year, and it's a elaborate documentation, elaborate process. Okay, so it's a big challenge. So anything to do with automated controls need to be tested during the year. That's the timing which is important. So the nature of the controls which you are testing has importance as far as the timing is concerned. Okay. Certain things can be done only after the year, certain reconciliations and everything. Extent of checking, again it is dependent on various factors. Okay, items which are increasing the number, lowering the materiality. Okay, performing multiple types of tests, it's very important. Okay. Response to financial statement level risk. I would say this is a big risk in small and medium enterprises. Because what happens, the people who are there, many times it is not intentional, there could be errors. Okay, so it is important. You can't land up preparing the financial statement, there is a problem. They will say, an auditor prepared the financial statement, everything wrong, you are responsible. You can help them to prepare the financial statement, but you cannot prepare the financial statement. Okay, so this is very important. Very often the staff is not experienced, they are not competent. There could be errors in the financial statement, there could be errors in the compliance of information which is given. So many things could be there. Okay, you need to ensure more supervision, more verification of the financial statement level. Evaluation, the other standards. See, evaluation of the, I will just briefly tell what is the common errors we pitfall we have. We identified misstatements and either they correct it or you document it's not material. This is normally which is there. The first step itself is documentation of what you identified as an error. That itself many times we forgot to do, or it is done in some work papers. It is not done at centrally. So the standard requires all the misstatements to be documented at one place. Okay. Now, the practical thing is ensure that the client passes entries, either it is material or not material, ensure he passes the entries to rectify them. As far as the standard is concerned, you are supposed to have a material misstatement. You are not only the misstatements you identified, there is something called projected misstatements. Suppose you are verifying certain part of the sale. You identified certain sales have been done without goods have been dispatched. It's not enough to identify that as a misstatement. You need to project based on the samples you have selected, this is what's happened, what could be the projected misstatement. Okay? First thing is you may have to enhance the scope of your audit. Okay? As I tell you, as I speak, in practice, now we have tools, we can ensure that you can extend it, we will not project. You can actually test the thing. You can actually go and take the entire dump of the sales, identify goods have not been dispatched because the reference may not be there. You can actually test for the whole population. It is possible. Okay, we are actually proceeding in that thing. Even though the standard doesn't require, it's not difficult to do it because the tools are available. Or you can ask the client to run, ask him to do the report and test the report. Okay. So you need to, the projected misstatement, we need to use, in the olden days we used to project, this is what is the sample, based on this parameter, what could be projected one, mathematical calculation. Possibly it is not required these days, you can actually check and get the full data and ensure that the clients reverse it. Okay, we do it, for instance, year-end sales. The goods have not reached the customer, Ind AS requires a control being passed on to the customer. We ensure that everything, all the things, no sample, nothing. We ensure all the things where the goods have not been passed on based on the information, full statement, we make the client to reverse the sale. Okay? We could check it ourselves sometimes. Okay? So that is what the standard requires. Okay? The only thing which you need not document in misstatement is called clearly trivial threshold. I'll just touch upon something. What is clearly? Materiality you would have known. Materiality is based on what could go wrong, the limit up to which you can, a reader of the financial statements is not bothered, okay? If you want to use a colloquial term, that is materiality. But as far as the audit is concerned, you need to use something called a performance materiality, which is lower than the materiality. What is the performance materiality? It is basically lower to the extent of the probability of errors happening. It's a judgmental thing. If you say, normally when you start a client, you put a higher thing, say 10% or 20%. So your performance materiality could be 20% lower than the materiality. The entire audit process will be driven by that materiality. Okay? Now, then you identified a misstatement and all. Only things it talks about another figure called clearly trivial threshold. Audit is on material items. So that could be identified. You will find out the rounding off here, there. So you put an amount which is called clearly trivial threshold. That's what the standard says. That if it comes, you need not report, you need not document, you need not take it to the audit committee or the owners. You can look at it, is there a systemic issue? But otherwise, you are allowed that clearly threshold could be ignored. Okay? That will be a much lower figure. Suppose my materiality, I don't know, let's say 100 rupees, it could be 2 rupees. Okay? As low as that. Okay, this is what I have been telling, causes of misstatement, types of misstatement. Okay, judgmental misstatements. A lot of judgmental misstatements happen. In suppose you are making a provisions, the client make a judgment, they will win a case. It's a matter of a judgment. So that could be a judgmental error. Well, as far as an audit failure is concerned, the error of judgment is done at a lower level than, if you could prove it's only an error of judgment, it is not a gross negligence. Okay, technically. Okay, a judgment is a judgment. Okay, so this is a document. Okay, background, testing, misstatement noted, which I told you, projected misstatement. We used to extrapolate the errors, okay? Now we have tools, you need not extrapolate, you can actually check for the whole population. Okay? It's evolving, okay? It's not that perfect, but it will be evolving. I tell you, if you are a finance company, you are finding an error in calculation of interest. You need not extrapolate. You can recompute the entire interest for the year and identify what is the correct interest and costs and country. Okay? For instance, if you are, I had a client when I was doing tax audit or say TDS, long time back. So the TDS input in the system was wrong. Some errors in the thing. So we identified, we took the Excel spreadsheet about 10 years back actually. We recompute the entire TDS shortfall and we gave it to the client, this is a shortfall, you have please rectify. We were very happy with what we have done. Because we did the full TDS, because the management is responsible for deducting correct TDS. They could actually pay the TDS, pay the interest, we gave them full. So the value add which you bring into the client for identifying the full errors is phenomenal. Okay, so one of the things which you identified in extrapolation is the magnitude and likelihood. Magnitude is an amount, likelihood is the frequency in which it could happen. Okay, it could be a one-off thing in a balance sheet item, or it could be a repetitive item if related to transactions like sales, purchase and all. Okay, this is the entire chart. Very often this is missed out, we don't document it properly. It's not a very difficult thing to document, okay? It needs 2-3 sheets, put it together, ensure the whatever is appearing in the file somewhere or the other is transported to the statement, okay? But it is missed out many times, okay? So ideally you should have a section for material misstatement, put it in the file and ensure that people put something on the file. Then only you can ensure that it is done. Communication of misstatements. Yeah, communication of misstatement is basically those with the management as well as those charged with the governance. You need to ensure that it is appropriately done. The misstatements are rectified, or if it is something related to internal controls, they take steps to rectify them. So as an auditor, you are responsible that you communicate with those charged with governance. In smaller and medium enterprises, those charged with governance can be only the managing director or the owner itself, possibly. Okay, there may not be a board may not be any independent people. If it is a listed entities, you need to ensure it's appropriately communicated to the audit committee in writing. Okay. One of the things which is there, a standardized entity using service organizations. Basically, in brief, service organization is anybody whom the company uses it for processing. Suppose for payroll processing, I am using an external service provider. It's a service organization. So you have to ensure how that user service organization affects your audit. Is there any controls in service organization which is affecting your audit? So the standard talks about 2 types of report, type 1 report, type 2 report. You need to get the service organization audited for the controls which are existing there before you rely on it, because otherwise you will not be able to go and do the audit because it will be some external party. So this is again missed out in smaller and medium enterprises, and there are challenges. For instance, the entire account preparation or maintenance of accounts could be outsourced to a chartered accountant firm. It's a service organization. Okay, so you need to look at it how you address it. Okay, you need to check with them what are the controls they exercise. Okay. So this is all what is the thing which is required. The reporting and the 4.2 I'm not covering in detail. These are the things which are normally done by smaller entities. Use processing of transaction, maintenance of accounting records, preparation of financial statement. It's a challenge. It's a challenge. How do you verify it? Okay. The same way as misstatement, understanding of control deficiency, it's a very elaborate topic. So if you identify deficiency in control, you need to address them. Now, if there is a deficiency in control, now if you are doing an internal control over financial reporting report, you may need to qualify, you need to put something in the report, but it not necessarily qualify the accounts. But if you are qualifying a financial statement, it's true that generally there will be a qualification of internal control. Generally. Okay? So that's very important. Again, you have to communicate with those people. Any questions? Thank you.
Thank you, Mr. Sundaresan, for touching upon the important aspects of risk, assessment of risk, internal control procedures, and also touching upon the importance of risk documentation, control documentation, and how it is equally important for a small entity and not just for a bigger organization. A whole round of applause, ladies and gentlemen, to and I now request CA Ananda Krishna to kindly come forward and present a memento to our first session speaker for having taken his time off for us. Friends, we shall now break for tea and reassemble after 15 minutes.
Internationally, there is a lot of discussion on whether the auditing standard should be used for the small enterprises. There is actually a project to do auditing standard for small medium enterprises. It's going on for quite some time. But IFAC has actually published guides for using the auditing standard for small medium enterprises, which is quite nicely done. Okay, so there are 2 volumes. See, this is the publication I have downloaded. Anybody can download it. You go to the IFAC website, put IAFAC, go to the website, you have to register yourself. It's not difficult, you have to put your minimum data and you will get registered. Once you register, you can go to this, click on this guide, you can put there in search guide for NRA and you can download it. Okay, it's not you will not pay anything for it, it's a free download. See, this is in 2 volumes. First volume is on concepts and the second volume is on practical application. It's quite useful. It contains case study and explains each of the standards. The standards are quite abstract. I would have actually done a workshop for running in 2 days. Okay, that is what is done in that things. If you see here, they have done a very nice thing of explaining the standard in sentences, which is very good, very simplified terms, and they have given a lot of things which should be easy to follow. Okay, they have not just followed the standard, they have followed the thing of practical application of the standard. Okay, they have put a summary. There is a lot of charts which are being put in there. In fact, the second volume, if I show, you will know what is how useful it is. This is the second volume. This is a practical guidance which is in volume 2, which I think will be very, very useful. You can go through it if you are practically doing audits, you can use it. It actually has got case study explaining it. It has actually got the documentation how to do it. Okay, I don't have the time to do it. For instance, risk assessment. It says what are the things you will do, how will you document that? There is a sample of documentation which is available. That is what we normally miss out. Okay. So, for instance, introduction to case studies. The whole volume is written based on some case study. In fact, only one thing I want to show you. The case study is an Indian name with it. There are 2. There is one case study which is say Kumar and Co. And the circumstances which are given is typical Indian. Okay. One is Devta Furniture and the second one is this is your case study for you. Okay. Kumar and Co. Okay, they have given data and then each of the standards they have referred to this case study and then they have explained what is to be done or you have to fill it up. Okay. So it's a very nice publication. So you download it and keep it, it's very useful. Okay. Whenever you can, it's a reference point for you. Okay. Because I don't find anything better publication which is useful. Okay, we have this auditing standard. You read the auditing standard, you will not understand. It's all abstract. There are some technical terms which are used, but this volume they have made it simplified. They have put practical example. They have given how in practice what kind of thing could happen. So it's a sort of guide which you can practically use. Okay. We believe that it is Greek and Latin, it is not. It is basically putting down in writing what we have discussed, what we have identified, it's simple. Okay, I'll just show you one example of documentation in respect of risk assessment, what they have done. Okay, and then there is a file note. This is what we discussed, risk assessment. These are the things which are there available. Okay, it says activity, purpose, documentation in very clear terms, in a form of a flow chart. Okay, so in a very simple manner it is being discussed, and it is also very nicely put it up. It's easy to read. It's not boring. Colorful things which are not there, which is not there in the standard. Okay. For instance, before accepting engagement, what do you do? Planning activity. Okay, how the whole audit flows. In the risk assessment flows through the audit, it is there. Engagement, acceptance, continuance. These are the things which is required, which is, and they have put the relevant extracts in a simple format. Whatever is relevant, and they have put it there. There is an overview. And what are the things which need to consider, they have highlighted. Okay. This is important. For instance, see, they have said what is to be considered and what is the line of inquiry. Okay. You just put this and then do the work. That's it. Okay. So it's very useful. For instance, each and everything, are the risks involved acceptable? It's a very practical thing. None of the audits, none of the things will be zero risk. There will be risks. So now, before accepting it, how do I classify that engagement? That is what they have put in there. Higher risk. The engagement itself could be higher risk. It will be heightened level of skepticism. So those are all very nicely put up here. Background checks, preconditions for an audit. Agreeing terms of engagement. That's simple because we just take the standard thing and put it there. It is there in every part of the auditing standard. Okay. So everywhere there is a case study which is linked to that. Okay. So this is relating to that case study which is there. Okay. See here, the letters which is given in respect of that, they have given there. This is simple, but each and every chapter you will have this kind of thing on that case study. See, this is an overall audit strategy. In fact, they have given a documentation what should we have to file at the end. See, everywhere they have said what is the considered point, highlighting what is to be done. Okay. This is absolutely very important, like a manual. How you do the audit, it will be very useful. See here, documentation. See here. This is
what is the type of documentation which we do. This what is called audit strategy. Audit strategy is after doing all your client related work and planning, then you work out a document called audit strategy. The way you will do the audit, it's audit planning management call. This is what it should be. What is the scope? This is actually the documentation of an example, okay, of the example case study which they have given. They have just documented what could be the documentation of the audit strategy. What is the scope? What are the changes which is made in the entity? What is the risk? Okay. What is the overall audit strategy? So that is all documented. It's a simple one-pager. See, this is on Kumar and Co. What is the audit strategy for the audit of Kumar and Co. Which is an example which is given there. Okay. It's considered to be a moderate risk. Okay. What are the changes which has happened in the entity? What is the overall audit strategy? When do you do risk assessment? If you see here, perform risk assessment at end of December. Okay, even that is documented. Very simple, use the same staff as last period for continuity and audit efficiency. As simple as that is being documented, okay, it's very important. It's always not possible, practically, because but if you could do it, you could document that and you do that. Attend the period and inventory count, expand our testing with regard to related party transactions, okay, and the partner signs off. So this is the example of the documentation which is needed, which is there every auditing standard, okay. This is where I think as a profession we lack, or we are still behind. We are our culture doesn't encourage documentation. People will go meet, they will do everything, but they will not put down in paper. How many times do you go for a minute in the client, you write the minutes of the meeting? The way the others work in other geography, everything, the next day you will find the minutes on your table. They will have come and met you, you will go there and they will send you the minutes. Okay? So that is a thing which we need to generally actually improve, and that's where this will be helpful. It's not very difficult, it's a question of discipline, put it there in each place. And check at the end of the audit that all the documentation has been done. It's not that sometimes you miss it out. One of the things which before you close a file, to ensure that all the documents of meetings and all these kind of documentation is in place. If it is not done, you could just do the documentation before the file is closed. Okay. Normally it should be done then and there. Okay. So these are the things which are there. See how to determine materiality. Okay, this is a practical challenge. So there are certain guidance. Okay. There are certain guidance, there are certain points which could be considered of practical use. Okay. What is the right benchmark to use? Who is the type of user, specific user experience? Like I told you on performance materiality, what are the considerations? It's very nicely done, especially the second volume. It's like a Bible, you can use it as a manual for you for doing the audit. Whatever type of audit you do, it will be useful. If you see the way it is written there, it is readable, okay? Unlike the standard which is a sort of various pages, here it is written in a very short form, okay? Sorry. So you can download it and keep it, I will suggest. It will be useful for you. Okay, quite useful. Thank you. Thanks, Shyam. You have to register in the IFAC site with your credentials, and then you can download it free.